Hey guys, Ken Boyd with the Accounting Accidentally website, where you can find over 350 blog posts on accounting and finance topics, and also links to over 350 of my YouTube videos. This is the latest blog post where Airbnb's profit struggles teach us about contribution margin. So everyone's familiar with Airbnb. They have huge brand awareness, but it's struggled to produce consistent profits. And a Wall Street Journal article from last week talked about the profit struggles, which is a big deal because they're trying to launch their IPO later this year. So here's a couple quotes. The company has the largest home sharing platform in the US with more than 2 million people on average booked in night listings worldwide. I thought that was an interesting number. I didn't know it was that large. And the board in recent weeks grilled executives on why expenses are outpacing revenue. The revenue was up. Revenue was up from the prior year period, but costs rose faster. So their net profit for the quarter was down something like $80-90 million compared to the prior period. And their costs are increasing in several areas. Safety program, the company has a safety program to address theft, prostitution, and other crimes among its hosts and guests since its founding. So it's a safety issue. Second, technology, not surprising, they're a technology company. Upgrading the technology platform, running $100 million a year. Huge number, but they're a tech company. And finally, home office costs. We have a term in accounting called SG&A, selling, general, and administrative. So it says here, one of the category of costs that has grown particularly fast is general and administrative costs, which more than doubled year over year. So they're paying for the headquarters, legal and accounting, and human resources functions, which are overhead costs because they can't be directly tied to a product or service. So company growth is difficult to manage, but one useful tool is contribution margin. And I've written about it in my Accounting All-in-One for Dummies book. The basic formula is sales less variable costs. And the way I like to explain it is if you take sales less variable costs, the amount of money you have left goes toward two things: covering your fixed costs, and anything that remains is your profit. So you got to picture sales less variable cost has to go toward covering that fixed cost number, and you need to look at it in total dollars, which I'll get to in a minute. So here's a simple example. Julie's hardware store has $600,000 in sales, $200,000 in variable costs. Contribution margin's $400,000, and out of that, she has to cover $250,000 in fixed costs like rent, insurance premiums, and the remainder is $150,000 profit. And that basic formula brings us back to Airbnb. The goal is to grow sales at a faster percentage rate than your variable costs and total fixed costs, and that is not happening at Airbnb. And when you use contribution margin, you should always look at covering fixed costs in total dollars, not per unit. Think of fixed costs as a set amount of money that you pay before computing profitability. So the problem is that Airbnb's costs as a percentage are growing at a faster rate than sales from both a fixed cost and a variable cost perspective. So the lesson is you can't outrun increasing costs by simply selling more. You got to think about cost control, and cost control is really a management issue. And if you're smart about making decisions about costs, you can improve your profits even in a flat sales year. So this is really about cost control and less about selling more stuff. So remember, Accounting Accidentally, you can go and find over 350 blog posts, links to my YouTube channel, 450 videos on the channel, and a lot of them are on the website. Thanks for watching, and we'll see you next time.